Assalamu alaikum. Dear student, extremely important lecture. That is in ATX English is 101. In Urdu, the number is little bit different. Dear student, in this lecture, we will cover two very small topic but very important. And then we'll be doing one past paper question on these two topics. It was lecture number 79. The way back we studied IR 35 personal service company. Actually, what happens in PSC personal service company that one individual, if you just try to recall what we studied in lecture 79, it's the same number in Urdu and English as well. In personal service company, what happens that one individual, for example, Mr. X, he sets up X Limited, and through X Limited, Mr. X actually provides services to the client. Then what do we do for calculating deemed salary? We apply IR 35. Now we are studying the same thing with the perspective of medium or large organization. We are studying the same thing with the perspective of a client who is actually taking the services and making the payment against the services. So according to HMRC, the client who is taking services and obviously making the payment, if that client comes to know that personal service company rules are applicable, then that medium or large client will have to inform to the provider of services that, look, personal service company rules are applicable. That is why the client who is taking the services will have to calculate deemed direct payment, and on that deemed direct payment, that organization, the one who is taking the services, needs to calculate income tax as well as class 1 employee NIC and as well as class 1 employer NIC also. So now try to first understand the scenario. Services provided via personal service company to a medium or large organization. Where a medium or large client organization engages with a personal service company, it is the responsibility of a client to determine the status of the individual worker. The client will issue a status determination statement to the individual which sets out their determination. If the client determines, means decides, that personal service company rules should be applied, then it is required to calculate and pay the income tax and NIC on the deemed direct payment. So if the client determines that personal service company rules are applicable, then you have to calculate and pay income tax as well as NIC. How do we calculate deemed direct payment? Very important format. Payment in respect of services provided net of VAT, means excluding VAT, less the direct cost of material incurred by the personal service company. If personal service company has incurred any material cost, you have to deduct that. Less deductible employee expenses incurred by personal service company. If personal service company has incurred any deductible employee expenses, again, if it comes in exam, it will be given to you. You have to deduct that also. This is how you calculate deemed direct payment. In order to avoid double taxation, the deemed direct payment is deducted from any payment made by the personal service company to the workers, such as salary, before calculating income tax and NIC on that payment. For example, if the salary given to the worker is 80,000 and the deemed direct payment is 40, you have to first deduct the 40,000. So logically, the remaining 40,000, you can say this is the salary of the employee worker who has to make income tax and NIC payment on this 40. So you need to deduct the deemed direct payment from the salary of that person. For example, the salary amount is 90 and the deemed direct payment is 30. So you need to deduct 30. So logically, you'll be saying that salary on which that particular individual needs to pay tax is only 60,000. Because on the 30,000 deemed direct payment, we have to calculate the income tax and NIC. Read it again. In order to avoid double taxation, the deemed direct payment is deducted from any payment made by the personal service company to the worker, such as salary, before calculating what? Income tax and NIC on that payment. So basically you need to deduct deemed direct payment from the salary. GOK provides interior design services through a personal service company. GOK provides interior design services through a personal service company, Vaughan Limited. So Vaughan Limited is the one through which GOK provides services. Vaughan Limited has a contract with the Bless PLC to provide GOK design services. So Vaughan Limited is working as a personal service company, and Vaughan is making a contract with the Bless that GOK is going to give you, provide you the design services. Bless PLC is classed as a medium or large size client organization and has issued status determination statement to GOK, stating that his services fall within the personal service company rule. So basically Bless PLC are saying your services, they fall under personal service company rules. Vaughan Limited, which is a personal service company, has sent Bless PLC an invoice of 20,000 excluding VAT, which we need. Had it been including VAT, we would have made excluding VAT. So it is already exclusive of VAT. For GOK design work for the year ended 5th April 2023. Vaughan Limited, again personal service company, incurred expenditure 500 in respect of the stationery use in the provision of the design. This 500 is a direct material cost incurred by the personal service company. Calculate the deemed direct payment arising from the relevant engagement. Very simple. 20,000. This is 20,000. Let me use this. So 20,000 is the payment in respect of the services provided, net of VAT is 20, less the direct material cost, which is 500. We don't have this. So basically 19,500 is the deemed direct payment. And Bless PLC will need to calculate income tax class 1 and class 1 employee and employer NIC on 19,500 as if GOK is the employee of the Bless PLC. Repeat, on 19,500, Bless PLC needs to calculate income tax as well as class 1 employee and employer NIC. Simply Bless PLC needs to deal with this 19,500 and GOK as the GOK was a direct employee of the Bless PLC. So dear student, it is very much possible in exam you might be asked to calculate deemed direct payment, and examiner might give you for this 3 to 4 marks or maybe 6 marks. 3 to 4 marks for the discussion and 3 to 4 marks for the calculation. I'm discussing one more rule, and after that we'll be discussing a past paper question on this topic, deemed direct payment. Don't worry at all. And if you have a book, so in the book you can also see the answer of this test you're understanding. 6. Now I really want to discuss one more topic with you, and that topic actually relates to inheritance tax payments. When we can make inheritance tax payments through installments. So before I bring that page on the screen, let me save this page for you. Okay, dear student, the way back we did discuss when do you have to make payment of IHT. So what are we discussing right now? Why we are discussing again? Actually, we're not discussing again. We are discussing something left in this topic. Before discussing when we can make IHT payment on installments, let us first discuss what are the normal payment dates. Transfer CLT between 6 April and 30th September, due date is 30th April in the following tax year. If CLT is between 1st October and 5th April, then it is 6 months after the end of the month in which the transfer is made. So simply if the CLT is between 6 April and 30th September, then due date is 30th April following the tax year. If it is between 1st October and 5th April, then 6 months after the end of the month of transfer. Simply PAT becomes chargeable as a result of death 6 months after the end of the month of death. Okay. In case of CLT, becoming taxable due to death within 7 years. So simply death tax either the PAT becomes chargeable due to death, or on CLT you are paying additional tax. Simply death tax is paid 6 months after the end of the month of death. Tax at death estate is paid actually earlier of 6 months after the month of the end of the death, or on the delivery of estate of accounts to HMRC, whichever is installment, whichever is earlier. And leave this installment part we are discussing right now. Interest runs from the 6 months after the end of the month of the death if you are delay in making payment. So these are the normal dates, the way back which we did discuss. Now what are we discussing? Now, dear student, a very important concept, you can say the rule which we are discussing is payment by installments. So dear student, first you need to know uh, when do we allow to make payment by installments? What are the qualifying assets on which we can make payment by installments? IST on land and buildings. So you can say one, land and buildings, a business, and or interest in a business that you are having some partnership, and certain shares can be paid in 10 equal annual installment. 10 equal annual installment means 10 years. Starting on the normal due date. That is very important. That 10-year period starts from the normal due date. And we know that what are the normal due dates. For example, in case of death, the normal due date is 6 months after the end of the month of the death. So these 10 equal annual installment, they start from the normal due date. The asset must still be owned by the donee. That is very important. When you are going towards 10 equal annual installment, then asset must be with the donee. If it is sold, the whole of the outstanding installment becomes payable immediately. For example, being in donee, let's say you have paid 2 installments. Still 8 installments are left, but you have sold that asset. Then entire remaining amount of IST becomes payable immediately. Payment by installment detail. The tax must arise on any of the following. That is estate at death. It could be lifetime gifts made within 7 years before the death. Lifetime gifts when the donee has agreed to pay the tax arising. The tax must arise on any of the following. It can arise on death estate. The lifetime gift made within 7 years before the death. And the finally is lifetime where the donee has agreed to pay the tax arising. Okay. The assets to which the installment basis applies are the land wherever situated. This is number one asset. The land wherever it is situated, IST on the land you can make payment in 10 equal annual installments. Shares or securities in a company with a transfer controlled the company immediately before the transfer. If you are having a control, let's say you are a parent to that company, in that case, whatever IST is coming on those shares or securities, IST will be paid in 10 equal installment. Third, shares or securities in an unquoted company where the tax arises on death. This is taxes arising on death. And the amount of tax payable on all installment assets is at least 20% of the total tax payable on the estate. Actually, every asset's IST payable does not qualify for installment. Assuming you have shares or securities in an unquoted company, okay, where the tax is arising on death, that is very important. And it says the amount of tax payable on all installment assets is at least 20% of the total tax payable on the death estate. Assuming IST payable, I'm just assuming, okay, IST payable on death estate is assuming 200,000. If IST payable on death estate is 200,000, then those assets, they are qualifying for 10 equal annual installments. IST on those assets must be at least 20% of this amount. 20% of this amount means 40,000 pounds in my example. If IST on qualifying asset is 40,000, then you can use the 10 equal installment option. Shares or securities in an unquoted company where the tax arises on death and amount of the tax payable on all installment assets is at least 20% of the total tax payable. For example, if the amount is less than 20%, then installment option is not available. This is about third. Fourth, shares of an unquoted company, private company with a value in excess of 20,000. Let's say you are having shares in an unquoted company, the value must exceed 20, which represents 10% or more of the nominal value of the company's shares. What do you mean by this? Let's say uh, the donor is having shares in an unquoted company. One, the value of the share must be more than 20,000. Second is it must be 10% or more of the total nominal value of the company's shares. What do you mean by this? Nominal value means share capital. Assuming that private company is having a share capital of, I'm just assuming the share capital of, let's say, 200,000. So basically, if the share capital is 200,000 and the value of the shares in the private companies are, for example, 25,000, then your condition is met. How? Shares of an unquoted company with a value in excess of 20,000. So it is 25, which represents 10% more of the nominal value. Yes, it is representing 10% or more. How? The 10% of 200,000 is only 20,000. And you are having shares. They are having value 25,000, which is more than the 10% of the total nominal value of the company shares. In that case, whatever IHT is arising on these shares of an unquoted company, you can make payment in installments. The last is the business. Let's say you have given a business as a gift or an interest in the business. For example, you are having a share in the partnership and you have given that share in the partnership as a gift. Again, you can make the IHT payment on such gift in 10 equal installments. But last point is very important. Note that a business or an interest in a business would usually qualify for 100% business property relief, BPR. If so, no tax is due if the transfer did not qualify. For example, business had not been owned for 2 years. The installment option could be considered for any tax due. So simply if BPR is applicable, then no installment issue arises. And obviously when BPR is not applicable, then you can go for installment options. So dear student, I really want every one of you, you must know that IHT can be paid in 10 equal installments and 10 annual equal installments, and they start from the normal due date, but every asset is not qualifying for installment options. Land, wherever land and buildings, they qualify for the installment. Shares of securities where donor is having a control, and these are the 5 assets. I really want every one of you try to memorize these 5, that these are the 5 qualifying, you can say, assets, and IHT which is coming on these 5 qualifying assets, you can make payment through 10 equal annual installments. Now let me share a past paper question in which examiner has examined both the concepts. The examiner has asked when IHT can be paid in installment, and second, he has also asked you to, in that particular question, to calculate deemed direct payment and NIC and everything. So let me bring that question. So this is the question 52 from your new kit, Canden and Amahle. Let's properly solve and discuss the question. Just a minute. Let me increase the font size. Yes. A1, what it says, explain with supporting calculations the capital loss which will arise on the proposed sale of the antique chairs to Nathi and how this loss can be relieved. 4 marks. Explain with supporting calculation. Explain with supporting calculation. The capital loss which will arise on the proposed sale of the antique chairs to Nathi and how this loss can be relieved. 4 marks. Advice on the availability and effect of the installment option we did discuss right now for the payment of Nathi's inheritance tax liability in respect of the each investment property and antique chairs. We did study right now. We did discuss antique chairs. I did not see in those 5 assets which were qualifying asset on which we can make IHT payment through installment. Antique chairs, they don't fall in that. They're not qualifying asset for the installment options. On the assumption that Canden dies on 20th March 2028, very important concept. Your 10 annual equal installment starts from the normal due date, and the normal due date in case of death tax is 6 months after the end of the month of death, which means if Canden dies on 20th March 2028, so when will be the normal due date? Number one, you will have to leave the month of the March, then go to the end of 6 months from the end of the month of the death. So that completes on 30th September 2028. So actually the normal due date is 30th November 2028. From here onwards, you can make 10 equal annual installments. No calculations are required. They are just asking the discussion in A2. B1, calculate deemed direct payment from which the large client must deduct pay NIC for the tax year 23-24 on the basis that personal service company legislation applies and Canden has been issued with a status determination statement by the large company. Actually, large company is checking your status and they are asking us to calculate deemed direct payment. Okay, so you should remember that format of calculating deemed direct payment. Calculate Caden's class 1 NIC income tax liability that is payable to HMRC by the large client. So how much large client will have to make income tax liability and class 1 Karen's NIC. They're not asking us to calculate employer's NIC. Simply they're asking us to calculate Karen's income tax and Karen's class 1 NIC based on your deemed direct payment calculation part B1 above. C, for the tax year 23-24, advise Amahle why the interest receivable in respect of her bank account in the country of Comore will be subject to UK income tax and explain with supporting calculations why this will not actually result in any UK tax payable. Wow. First you have to explain that interest receivable by Amahle in the bank account in the country of Comore in a foreign country, why it is subject to UK income tax. So the interest income which Amahle is generating in the country Comore, one, you have to tell us why it is subject to UK income tax, and then you need to explain with the help of supporting calculation why this will not actually result in UK tax payable. So we have to, let's read the question. Professional marks will be awarded for the demonstration, skill analysis, evaluation, commercial acumen and everything. Let's read. You should assume that today's date is 1st September 2023. Canden requires advice on capital gains tax implication of the proposed sale of antique chairs, payment of the potential inheritance tax liability in respect of the 2 lifetime gifts, and the application of personal service company IR 35 legislation. His wife Amahle requires advice on the income tax implication receiving overseas income. Okay, Canden is resident and domicile in the UK. We know that whoever is resident and domicile in the UK will have to pay his or her worldwide tax on his or her worldwide income. Similarly, we'll have to make IHT payment as well. Will sell 4 antique chairs on 6 October 2023. Is the sole shareholder, director and employee of Medini Limited. Acquisition of antique chairs. Canden was gifted a set of 6 antique chairs by his mother. Canden was gifted a set of 6 antique chairs by his mother, Phoeba, on 3rd March 2021. The chairs had a market value of 1,52,000 on that date. FIBA had purchased shares for 1,06,000 on 8 August 2011. Very important point. This 1,06,000 is irrelevant right now. For Canden, the cost is 1,52,000, which means that when Canden is going to sell these shares, then the 6 shares having a cost 1,52,000. So Canden was gifted a set of 6 antique chairs. So basically the cost for the Canden is 1,52,000. Sale of antique chairs. Canden sold 2 of the chairs to an unconnected person for 42,000. When you are selling it to unconnected person, whatever amount you are getting, that is treated as sale proceed. On 10th September 2021, the 4 remaining chairs were valued at that time 93,000. That did. Very important point, dear student, that the information which they have given us, that Canden was given a set of 6 antique chairs. We have find out already. We have found out the cost of those 6 antique chairs is 1,52,000. And now the examiner says that out of set of 6 antique chairs, 2 chairs were sold to the unconnected person. The sale proceed at that time for the 2 antique chair was 42,000, and the remaining antique chairs were having a value of 93,000. Dear students, it is a really big hint of the part disposal calculation. So we need to apply the rule of the part disposal for calculating what is the allowable cost for the 4 chairs. Because right now we are actually giving gift to the son for 4 chairs. 2 chairs Canden has already sold. Canden is proposing to sell 4 remaining chairs to his son Nethi for 35,000 on 6 October 2023. These 4 chairs are expected to have a value of 93,000. That did. Very important concept. Actually, you are giving these 4 antique chairs to your son, who is a connected person. So simply the market value will be treated as sale proceed. So let me solve A1 for you. Dear student, in A1 we need to calculate capital gains tax implication of the sale of 4 antique chairs. Capital gains tax implications on the sale of 4 antique chairs. Since these antique chairs are given to the son, so whatever son is paying less than the market value, that is irrelevant. The market value is treated as sale proceed. So simply sale proceed is the market value of 4 chairs. Market value of So right now the market value of the 4 chair is 99,000. Now dear student, we really want to find out what is the cost of 4 chairs. So we can calculate that. Less cost. Let me show you the working for this. Actually, the way back examiner has given us the information of the sale of 2 antique chairs. That will help us to find out what is the cost of the 4 antique chairs which we are selling right now, or simply we are giving a gift to the son right now. So let me show you the working here. The way back when 2 chairs were sold at that time. Cost of 4 antique chairs. How to find out that? Very simple. The way back we know that the cost is 1,52,000 for the set of 6 chairs, but 2 were sold. The disposal proceed was 42,000. At that time the market value was 93. So the cost relating to the 2 antique chair comes 47,289. Now listen and listen carefully, dear student. Actually 47,289 is the allowable cost relating to the 2 antique chairs. Those were sold the way back, not right now. So simply The cost of 4 shares we can easily calculate from 1,52,000. If I deduct 47,289, that gives us the cost of the remaining 4 shares 1,04,711. So the remaining 4 shares are having allowable cost of 1,04,711. So simply 1,04,711. Obviously we are having a capital loss. The amount of the capital loss is 5,711. Now the question is how this capital loss of 5,711 can be utilized. It's very simple. Karen can utilize this capital loss against the capital gain arising in this. Let's say Karen can utilize the loss against the gain arising on the, simply you can say against the gain arising on the further disposal to his son. For example, if in the tax year 23-24 you are selling more asset to your son and you are assuming taking money more than the cost, then capital gain will arise. Then obviously you can utilize this capital loss against that capital gain. So when the more capital gain will arise, you can, if in the same tax year capital gain is arising, then you can utilize this capital loss against that capital gain. If not, if no capital gain is arising in the same tax year in which this capital loss 5,711 has arisen, then obviously it will be carried forward and in the future it will be set off against the capital gain. So that was all about A1. Advise the availability and effect of the installment options. Previous lifetime gift, Karen, only previous lifetime gift was an investment to Nathi 2nd July 23 that result in a gross chargeable transfer of 380. Now let me tell you the availability and the effect of installment options. A2. So dear student, A2, what I'm just telling you what you need to discuss. Obviously you'll be writing in your own wordings. For investment property, first you need to put the heading of investment property. After that you simply need to write that land and buildings are qualifying asset for installment options. Definitely. For payment of IHT, and that payment of IHT starts from the normal due date and which is 6 months after the end of the month of the death, which is 6 months after the end of the month of the death. So simply Nathi can make 10 equal installments provided that Nathi should not sell the investment properties. If Nathi does sell the investment property, then all the remaining amount which were paid in installment, it becomes payable immediately. Another thing, the capital gain, whatever it is arising on the antique shares, that does not qualify, is not a qualifying asset for installment options. There are only 5 assets. They are qualifying asset for installment options. So antique chairs do not qualify. They are not qualifying asset for installment options. So I really appreciate after this you go and read answer of A part 2 at least 2 times. Let us see what is deemed direct payment and how do we calculate this. Medini Limited is a personal service company. This is a personal service company. For the purpose of IR 35 legislation for Canden to provide services to a large client. Sends an invoice to a large client 65,000 including VAT. If the VAT is including, then this value is 120%. To make it VAT exclusive, all you need is take 65,000, multiply this with 100 divided by 120. You will simply get the value excluding VAT, which is 54,167. Karen has incurred allowable employee expenses 4,000. We have to deduct this. Direct material costs 2,500. We need to deduct this. Both of these costs are met by Mandini Limited. So Mandini Limited is going to bear both of these expenses, so they are deductible. And Mandini Limited is a personal service company. So very easy to calculate deemed direct payment. From 54,167, you just need to deduct this uh, direct material cost of 2,500 and deductible employee expense of 4,000. So repeat, from 54,167, you just need to deduct two payments. One is direct material cost of 2,500, and then there is employee deductible expenses of 4,000. If you deduct these two from 54,167, it gives you 47,667. This is deemed direct payment. This is deemed direct payment. Dear student, you must be really good in formats. If you're really good in formats, so these deemed direct payments, such things will not disturb you. Now we need to calculate income tax and class 1 NIC for Canden. It is written in the question B2. So Karen's income tax, class 1 NIC. Actually, the deemed direct payment is 40. What was that? Deemed direct payment amount is how much? Oh, we computed over here. Actually, deemed direct payment amount is 47,667, and it is written in the question. Deal with the deemed direct payment as you are making payment to your own employee, and you need to calculate income tax class 1 employee and employer NIC. We are not calculating class 1 employer NIC because it is not mentioned in the question. Now let us simply calculate income tax on this 47,667. We have not been given any information of the cadence, any income. So simply let's calculate income tax liability. Assuming the entire basic rate band is available, so 37,700 into 20%. We'll get 7,540. We have not been given any information that Canden is already having any income. So from 47,000, where is this? The amount is 47,667. From 47,667, if I deduct 37,700, I'm getting 9,967 into 40%. I'm getting 3,987. Assuming this is 11527, this is your income tax liability, but let's make another assumption. Assuming personal allowance is not utilized. If personal allowance is not utilized, let us now deduct the personal allowance. So another way could be, because the rule says you deal the worker as this director was your employee. So let's say, of course, in sitting examination all, we don't know if this sort of question comes in this sort of a style. So simply we are making an assumption. If someone is following my answer 11527, then the assumption is personal house is already used. Otherwise, you can do one thing. Take this 47,667 less the personal house 12570. Let's see what I'm getting. 47,667 minus 12570. I'm getting 35,097. So you can directly calculate income tax. Just apply 20%. I'm getting 7,019. Now let us calculate class 1 employee NIC. They have not asked us to calculate employer NIC, so there's no need to do anything. Class 1 employee NIC. The amount is 47,667. Let us deduct 1257. First 12570 is having NIC rate 0%, then 13.25. I'm getting 4,650. So this is how you calculate income tax and NIC on deemed direct payment. Let's go back to the part C of this question. For the tax year 23-24, advise Amahle why the interest receivable in respect of bank account in the country of Comore will be subject to UK income tax, and explain with supporting calculation why it will not affect UK tax. Let's see. Amahle is resident and domicile in the UK, earns employment income 45,000 gross every year, receives interest income in respect of the bank deposit account in the Comore. Comore is a different country. Amahle is resident and domicile in the UK. We know that whoever is resident and domicile in the UK will have to make tax payment in UK on his or her worldwide income. And definitely you do get the double tax relief also, because if your overseas income is coming taxable in the UK and you have made already tax payment in the overseas as well on the same income, and now you're making tax payment in UK, in that case you will be getting a double tax relief, which is lower of tax paid in overseas and tax paid in UK. Either the double tax treaty exists or not, you will get the double tax relief. Makes a contribution to a personal pension scheme 3,000 net every year. 3,000 net every year means if I take 3,000, 100 upon 80, I'm getting 3,750, which means the normal basic rate band limit is 37,700, but Amahle is having a gross PPC of 3,750. So if I use the calculator, 37,700 plus 3,750, so we are getting 41,450. So basic rate band limit for Amahle is 41,450. On 1st January 2023, Amahle deposited 1,50,000 in a bank account in Comore. This bank account pays interest 5% on gross each year. We just need to take 5% of this 1,50,000. Amahle will not remit any of this interest income to the UK. Now listen and listen carefully. Either from the Comore, interest income is coming to the UK or not, since Amahle is resident and domicile in the UK. So one, Amahle will have to make payment, income tax payment on his or her worldwide income. Second, another very important concept which arising is, since you are resident and domicile in the UK, Amahle is resident and domicile in the UK, so whatever income is arising in overseas, you have to make payment in UK as on arising basis. Arising basis means it's not necessary that amount is actually remitted to the UK. If it even it is not remitted, you have to make payment of income tax. So only arising basis option is applicable in case of Amahle. So if I take 5% of 1,50,000, it is coming 7,500. Definitely on this 7,500 income, you have to make tax payment in UK, and you'll be getting a double tax relief as well. Don't worry at all. So basically, Emily is having an employment income of 45,000, and she is now also having an interest income of 7,500. So let me show you something. One, why the income tax arising on the interest income days? So you just need to write one thing. Since Emily is resident and domicile in the UK, so she has to pay tax on her worldwide income. Second, since she is resident and domicile in the UK, so she has to make income tax payment on arising basis, either that amount is remitted to the UK or not. Because remittance basis are not applicable, arising basis are applicable. Okay. So right now what is happening, let me explain. Non-savings. Now we have interest income, or you can say saving income, and then total. I just want to show you something. The salary is 45,000. Now we have an interest income of 7,500. If you take 5% of 1,50,000, it is coming 7,500. So 45,000 plus 7,500, I'm getting 52,500. Obviously, personal allowance is deducted from the non-saving income 12570. You will get taxable income. So 45,000 minus 12570, I'm getting 32,430 plus this. 39,930. Now listen and listen carefully, dear student. You have already obviously mentioned the examiner why interest income is taxable because Amahle is resident as well as domicile in the UK. So arising basis is applicable only. Either the amount is remitted or not, it is not important. Another thing, dear student, listen and listen carefully. Amahle is a basic rate taxpayer. Now the question arises, sir, this 39,930 is more than the basic rate band. Why Amahle is not a higher rate taxpayer? Because the basic rate band limit for Amahle is not 37,700 due to NIC due to personal service contribution. We have discussed that 3,100 upon 80, it gives us 3,750. So logically the basic rate band limit is 37,700 plus 3,750. If I use the calculator, 37,700 plus 3,750. So day student, it is 41,450. Now listen and listen carefully. Since the basic rate band limit is more than 39,930, it means, now dear student, try to understand. It means number one, the entire non-saving and saving income actually they fall in the basic rate band. Another point, by looking at 39,930 and now the basic rate band limit is 41,450, we can easily say that right now Amahle is a basic rate taxpayer. Now listen carefully. Whoever is a basic rate taxpayer gets nil rate band of 1,000 on the interest income. In this question, obviously, starting rate band concept cannot apply because in the non-saving column, the taxable amount is more than 5,000. So simply, I'm just applying tax in UK directly on this 7,500, which is the interest income. And then we need to explain why there's no need to make that interest payment. Tax on interest income. Actually, first 1,000, the nil rate band is applicable. Then 6,500 to 20% because of the basic rate band. So I'm getting 1,300. So the applicable tax rate is 20% and the amount is 1,300 in UK. Now let's see how much tax we have paid on this interest income in overseas. Tax regime in Comore. Tax is withheld at the rate of 18% all interest income. It says all interest income arising in Comore. In Comore, actually, dear student, they're not giving you any nil rate band. They're saying apply 18% on all interest income. The UK does not have a double tax treaty. Even the UK does not have a double tax treaty. Still, you will be getting double tax relief. So basically, on this interest income, they have already paid 18% tax. Let's see how much tax was paid in overseas. In UK, the tax which is coming on this amount, 7,500 is 1,300. So income tax in Comore, 7,500 into 18%. Interest income is 7,500. If I take 18% of this, I'm getting 1,350. Now listen and listen carefully. Actually, the double tax relief is lower of tax paid in UK and overseas. This time, the tax which is coming in UK is lower. So simply, due to double tax relief, 1,300 will become zero. So accordingly, no tax to be paid in UK. So repeat, income tax paid in Comore is 1,350. And income tax on this interest income in UK is coming 1,300. So obviously the entire 1,300 double tax relief is available. So due to double tax relief, there's no need to make any income tax payment in UK. So dear student, this is extremely important lecture. In this lecture, I did covered, you can say deemed direct payment rule, as well as when do we need to make 10 annual equal installment of IHT. So dear student, in ATX English is going to be 101 lecture. Now what I'm planning, because I'm planning around 2 to 3 more videos, that's it. So that you in ATX English somewhere it will be 103, 104, and that's a really good number, I believe, extremely good number. In Urdu, the amount, number is little bit different. So I'm planning, or otherwise I'm planning to go till 105 questions. After 105 questions, I'll be working on a smart revision. Okay. Inshallah, in a smart revision, I'll try my best within 12.5 to 13 hours to cover the entire course for you. So smart revision product, inshallah, it will be very soon available on, portal very soon, not right now. So that's it. Thank you very much for watching this lecture. I really appreciate after this video if you can just read the answer of this Karen question from the latest kit at least twice. And if you have any query, you can always ask. So thank you very much for watching this lecture. Have a nice life.